to the Inner Circle Boardroom's Backstage Pass with myself, Kate Chohan, and my co-host, Mike Elwood. This is the place you want to be if you are a busy professional on the go, interested in business, finance, and leadership. So the conversation for today is, are we in a recession and how long is it going to last? So with that said, let's crack on. Let's start with understanding the definition of a recession.
The official definition of a recession is negative growth for 2 quarters in a row. And it's pretty conclusive that that's where we are, quite significantly, and certainly more so than we've seen for some time. So I think, minus 20% more than. So there's no doubt that we are in a recession now. 2 quarters where GDP has gone backwards.
It's based on
domestic product, yeah. So the output of the economy.
We know that typically recessions happen every decade. The last one was 2008, and prior to that was the early 90s. I suppose I'd like to pose the question, and I'm sure you listeners are probably going to be thinking the same, is how and why do we forecast a recession every decade? To answer that question, do we need to compare the equities market versus the debt market? So if we look at global debt, it's at a record high than it's ever been, 255 trillion. Now, just to kind of break that down, that's around 32,000 for each of the 7.7 billion people on this planet. And that's mainly driven by governments and non-financial corporate sector. However, the bulk of that more recently has been around corporate debt. And the size of the global equities market in comparison is only 90 trillion. So basically, what we're saying is debt is cheaper than equities. And also, obviously, we've seen record low interest rates, which makes it extremely easy for corporates and sovereigns to borrow money. And I think that's the reason why we've seen the market quite high. I mean, particularly if you look at the stock market, it's overinflated. Mike, what's your take on that?
There's a lot in there. So let's just take corporate debt. So historically, companies were more conservative in the way that they were managed and governed, and were happy with lower levels of growth, and therefore didn't need to take the levels of gearing on to achieve growth that we see now. As people want to drive growth forward and expansion forward, then companies have to fund that. And they'll fund it either by raising equity, which is expensive, or by raising debt. And I think, as you highlighted, we have seen for the past 10 years at least pretty cheap levels of borrowing. So it's not surprising there's been an explosion of corporate debt within there. And it's been used to expand, it's been used to acquire things. So it's leveraged growth to get us to where we are now, which underpins the stock market valuation, I guess. So it's not surprising that we're there, but it's also not sustainable.
Yeah. Is it driven by greed? Is that a fair assumption?
It is a fair assumption, as long as you attribute greed to everybody and not just, because I know where you go with this with CEOs and other people. Actually, why do they?
No, I mean, you can look at nations as well.
Why do they drive for that? And it's driven because there's more people wanting to rely on their pensions. Therefore, we're living longer. Pension funds need more income. We have to drive corporate growth and output to be able to sustain that particular element. You're right, governments need to borrow, need to grow, provide more services for their people. So it's greed and growth. And I guess one thing the pandemic has done is made us just stand still and reflect, is that what we want society to do? Yeah. So it's not disconnected from what we're doing to the planet and the climate change program. So all of this growth that we've fueled by corporate debt is probably responsible for a big part of what's happening to the planet. And if you take that far enough, you lead into China, and that will begin to raise, that just magnifies the issue. You're taking on debt, it's either to expand and build more factories and produce more, or it's to acquire other companies and try and make your company more profitable. So it's all about growth in your revenue lines, which will support your share price and will satisfy your investors. But there's an important point to go back to, which is pension funds, 20, 25 years ago, relied almost exclusively on equities. And the equity market was volatile. And actually what they realised was that they needed fixed income to be able to pay pensions. So as long as you knew, if they got a return of 3.5%, that might well provide sufficient to meet their commitments in pension funds. So rather than buy the equity of a corporate, which was volatile, actually, why not take debt on a fixed coupon to meet your pension liability, and thereby take vulnerability out of the process? But of course, that's fine, but that bond market started really conservatively. And then people say, well, for a bit more yield, we could take a bit more risk. And then you end up where we are today, where there's a huge amount of corporate bonds out there with varying degrees of investment grade to junk grade.
Just on that conversation, if you were comparing, let's say, 2008, maybe even the early 90s as well, how would you compare the impact and the implications?
The last two are probably more similar. So people will tell you that it isn't similar because it's the pandemic that caused this. But pre-pandemic, there were all sorts of reports about the debt markets causing concern, stock markets causing concern, and that a correction was on its way. You have the impact of what's happening with the US and China over the trade wars. You had the impact of what was happening with Brexit. So some kind of correction was predicted already, and there is just that we've had a really strong run since the financial crisis in 2008, 2009, and there's a correction due, and I think that's what was happening. What did occur was the pandemic abruptly brought that to a point, and we're living with that now. I think that the real issue for me behind this is that in other recessions, you haven't had this societal change that we're talking about now.
Yeah.
So it's when we get the recovery going and we progress that we'll all be okay. So people talk about the V-shaped. I think the troubling thing for me at the moment is talking to people now around the centre of London is like a ghost town. Shops, bars, coffee shops are deserted, and it's not clear when that will come back. So other parts of the economy are recovering, but there are some parts that might never recover. And that's, I think, working that through with the kind of shift in working patterns for individuals. There's a lot more happening outside of the economy, which is going to impact the economy this time than I think happened the previous two times.
Where are the opportunities in all of this? Because I think there are opportunities. There's a lot of doom and gloom, businesses going bankrupt, the furlough scheme. If we look at unemployment, it was the lowest it had ever been. However, productivity was stagnant. And I think what drove that growth was the fact that it was low interest rates. And still what's driving that growth is the governments are pumping a lot of cash into the market. Money's quite free at the moment. You could argue that the pound is a lot more weaker.
So it's happening in Europe as well, happening in the States. So it's all relative.
Yeah.
But the productivity point is a good one. I think the UK particularly has had stagnant productivity for some time now.
Yeah.
And that's why things will naturally come to an end. So the worst thing that can happen in the UK would be rising interest rates. It's also what it needs, but it would expose an awful lot of flaws.
I don't think it's going to happen. Is that the interest rates are the part of the problem?
Yeah, it makes borrowing cheaper, and it also means because they're so low now, you haven't got anywhere else to go really. You get into this perverse world of negative interest rates where you're paid. You have to pay a bank to take your cash, or you're paid to borrow.
And it's in the innovation of the products and services as opposed to the cash.
That's my point about a changing economy. So you could have invested in coffee shops in central London. That would look like a great asset class. Lots of the sandwich chains in central London would have looked fantastic. Actually, now they won't. We need to find another way to innovate and to see where the economy will go, who will spend the money. But if we're not spending money, then it's difficult to see where the recovery comes from. And furlough, so these are all sequential. So furlough means a mixture of furlough and the COVID loans that the banks have put out, the bounce back loans and COVID loans, means that the impact on businesses is deferred. It's all in suspension.
79% of companies had their employees on furlough. You're not just talking UK companies, you're talking global companies, even American Airlines. Not talking about the employees just in the UK, you would be talking about the employees in the US as well. So that's where that's about.
So the challenge, therefore, is to work out whether those businesses are going to survive in a post-COVID world, whether they survive in the same form.
Companies are going to survive. They've been given free money.
Survive when they won't survive, and that means you move into unemployment.
Yeah, so if we talk about comparisons to 2008, you never saw the government intervene and start giving free money in the way that they...
Well, the reason it was done this way was to try and keep it short and sharp and say, actually, we're going to allow people to keep spending as if all of these businesses were open, so that the economy has the smallest dip and bounce back that you could have. But the pandemic has lasted longer than people originally thought it would. It's affected the way that we conduct our lives more than people thought it would. And therefore, actually, this furlough scheme has kept businesses going that might not survive. Businesses may not keep the same level of cost within it. And therefore, you're probably going to see a cycle of large unemployment. Now, that works okay if new industries are developed for people to retrain and move into. But I don't know I don't know how likely that is. I don't know really whether that's going to happen over the next 1, 2, 3 years. So you could end up with a situation of some fairly difficult unemployment, and it happens at the youth end as well. So it always happens where it's, graduates today or people leaving school today find it hard to get reasonable roles. And that's where it gets really tough.
Yeah, so I think there's a lot of chaos going on at the moment. If you're like me trying to make sense of all this, a difference between now and the previous recessions is the government's intervention, in the sense that it's a foot down on the press, basically printing a load of money. And I think it was needed. I think they acted with speed, and it was the right thing that they did for the survival of just keeping things going whilst the lockdown and giving confidence. I think the worry is around how do you sustain that. I think it's an opportunity for businesses. Interest rates are so low and cash is freely available. I actually think it's more of a shift in the ecosystem of a new economy, which is the digital economy, which has been fast-tracked. My firm belief is that jobs are going to go, and they have done over history. If we go back, let's take farming, for example, and when they started making tractors, you didn't need as many people on the farms anymore. But that created new roles. And I think this is the problem that I think we have, is we think everything is doom and gloom, and we're like, oh, that is really bad. So digital, what does digital actually mean?
Digital economy, digital is a channel. It's an infrastructure and a channel. It's not a sector in itself. It facilitates other sectors, and it's kind of finding, if jobs are being lost in different sectors, and I agree, it's happened over history. No one, if we open coal mines tomorrow, no one would want to go down them. Whereas it's only the 70s and 80s that they were around. So I get the fact that jobs change, but it's understanding what are the new sectors that are going to help younger people these days find employment. And it may well be that it's different. It may well be that it's quite different.
So going back to that conversation of, are we... and how long it's going to last. What's your prediction?
Well, we are in a recession, without a shadow of a doubt. But the very fact that it's been such a fall because of the way this has happened means that you can begin to climb out of recession quickly. Because if a recession is about periods of negative growth, actually it's not difficult after such a drop to record periods of positive growth. So you can technically get out of a recession relatively quickly.
Yeah.
Whether it is that V shape or whether it's kind of the steep in but a gradual out, and I'm more of the point of it's a gradual out. So I think we'll be out of recession quite quickly, but growth will be sluggish for a while, I think, for a good number of years until we go through what the job losses are, we replace those with new jobs, and the world order gets established. There's a lot happening in the US. So the US-China axis needs resolving. Brexit needs to happen. There's an awful lot in the mix at the moment, needs to resolve itself. And I think that's going to take a good few years to work through.
Yeah, so I agree with you. I already had slow growth because of Brexit. We've never really properly come out of the last recession. I mean, we've seen growth and we've seen unemployment be the lowest, but actually we've not really had
productivity really there, I think.
Yeah.
So what that really means is you've got people doing jobs who don't need to be doing them, but we're paying people anyway, and that's where I was going to go on to. So you say who's doing well now? So take somebody like Amazon. Well, what does that mean for people? And it means that you've got logistics people delivering parcels. That's where jobs are created. So you may have the high streets not working so well, so people are losing their jobs in the high streets. But if we're all ordering on Amazon, then we need parcels delivered to home. So there must be something in the logistics industry that's doing well. So people will do well around that. And you've got to follow the activity to see where the opportunities are.
Yeah.
So we've talked a bit of geopolitics, I think, haven't we?
Yeah.
So all that's happening in the US and China, I think, is important, and the growth of China. So if you look at we were talking corporate bonds before. I think the growth in corporate bonds has been no greater than it has been in China in recent times.
Yes.
I can't remember the numbers now, but it's something like 90 billion to 2 trillion in a relatively short space of time. So that's your Chinese corporates using bond markets, cheaper debt to grow. If that stalls, that's quite a heavyweight economy to stall. If you then add alongside that some of the standoff with the US and the trade there, then that's clearly going to have a huge impact on the world economy, just from that one axis. If you then look at what's happening with Europe and Brexit, then we've still got a lot to work through there before the end of the year. The prospect of a no deal, I guess, must increase every day we go that we don't have one, and we've lost sight of that because of the pandemic, but that would still have a huge shock. Now, part of that shock is cushioned because we've had the recession already. So the recession that everyone thought a no deal Brexit would spark has already happened. You can't stop spending twice. If you've stopped spending, you've stopped spending. Mm-hmm. So in some way that's cushioned, but there's a lot to happen with just those two events there around, what's happening with the economy around the world.
The US is going through a really interesting time at the moment. I think they are like China. They need to be very careful who they choose their battles with right now. Because you've got the re-election coming up, I think Trump is going to do everything he can to keep the people happy and just print a load of money. And they will do that because they want to be the number one leaders versus China. I think globally, I think what's happened is because with the Middle East and all the wars and everything else that went on the last few decades, I think what that did was, because we were so focused on that, we completely missed China. That's how they've got ahead of. I think India's in a really interesting place, but they're not the front winners because their currency is still quite weak. And I think Middle East has a lot of issues, especially with tourism and challenges with the oil and gas. And there's a lot of wealth there. And I think there's a lot of opportunities that are going to be from that area.
There are. I worry a little bit about London and financial services, because undoubtedly the split from Europe means that revenues that were earned in London won't be anymore because they can't be. So they'll have to move to Europe. I was confident London could weather that because lots of young people want to live in London. So Frankfurt's tried a number of times, Paris tried a number of times to kind of take over some of that financial centre from London, and it's never happened because smart young people wanted to live in London. Actually, the pandemic's changing an awful lot of that, and if that pull for bright young people into London doesn't exist, then it's right to stay as a financial capital comes under threat. And the very thing we talked about before about digitalisation and the need not to be present means we might not punch above our weight to the same extent that we did. And the UK is going to have to find something else to dominate our economy in the way that financial services has. So I think the last 6 months means that as we trundle towards Brexit, our position isn't as strong as it was, I don't think. And it's something that concerns me a little.
Where do you see opportunities?
It came in because corporations span, good corporations span lots of different countries. So, the rise of Amazon seems unstoppable right now. So actually the opportunity is if Amazon are the large beast progressing really well, you need to look off of that and say, what opportunities are there to work with Amazon? So is that in kind of supply to Amazon and what they do? So logistics businesses and smart logistics businesses, think about what our problems are. Is it about not being in when a parcel needs to be delivered? Well, how do we fix some of that? And that probably lies in good and smart technology. So work with the success stories and those that look like they're going to be around a while and find out how you can supply them. We've talked in previous podcasts around electric vehicles and the development of the electric vehicle. So actually it's undoubted that that's going to be a growth story over the next decade. So what can you do around that becomes part of the supply chain that's changing within electric vehicles and autonomous vehicles? So I think it's looking for those success stories and growth things that we can see now and asking how you can be part of that journey.
If I had to pick a country right now, would I rather go to China or India? I would rather go. Costed about 6.6%. Obviously that's been dropped, but it's still going to be a front runner for anybody.
Yeah.
Well, I definitely think India is a good place to be. I know the only challenge with India is doing business there, but if you know someone who knows that market very well, then make those connections, and it will make it easier to enter that market.
It's a large population with a lot of smart people and a big internal market to go out, never mind external. So there's huge potential.
Yeah, and the infrastructure there is not as developed as it is in the UK. So if you're looking from a resource perspective, it's the place you want to sort of be and tap into. From a digital perspective as well, and from a banking perspective, great market to enter. So I really see opportunities there. That is my it's the one that if I had to put any money on, that would be the area. The other part is the Middle East as well. I think there's a lot of capital in the Middle East. I know there's a lot of doom and gloom on the newspapers and the papers about the Middle East and, everyone, the expats all coming out of there, but I see a load of opportunities there. And there's a lot of wealth there as well. So that would be my second one. So those would be my two areas. So would you? And
then there's Latin America and South America and what's happening in Brazil. Yeah. Brazil's another powerhouse waiting to go. Has its challenges around corruption, which it never seems to quite shake off. But again, it's another vast country with lots of potential.
Cool. All right. Well, look, guys, I hope you enjoyed that conversation. Let us know what you think, whether you agree, disagree. Let us know what topics you're interested in, like some of you already have, and me and Mike will try and answer those for you. Over the next couple of weeks, we're going to be having interviews with other business leaders as well. We're going to be having another conversation, so click over to our other recording up there or there, which is going to be talking about unemployment, particularly youth unemployment, to universities having the modern workplace. So if that's something that's of interest to you, get involved in the conversation. We'll look forward to seeing some of you there. Thanks. Bye-bye.